Prudential just dropped its 2025 results, and they're talking a big game about double-digit growth. But what does that really mean if you're an investor? Well, in this explainer, we're going to dig into those numbers, uncover the strategy behind them, and figure out what it all means for you. Let's get right into it. So, right from the top of their press release, Prudential sets a really powerful tone. You see, this headline isn't just some marketing fluff. It's a clear promise. It's a commitment to performance and to its investors. And it pretty much frames everything else we're about to see. All right, here's how we're going to break this down. First, we'll get the big picture verdict on their year. Then we'll decode those double digits. After that, we'll look at the strategy that's making it all happen, see how they're rewarding shareholders, and finally, we'll look ahead at the opportunities and, of course, the risks. So Section 1, what's the final verdict on 2025? The message from Prudential is loud and clear. It was a year of really strong, consistent growth. And this wasn't just in one specific area. It was felt across their entire operation. Yeah, and this wasn't some last-minute sprint to hit the numbers. The company is really stressing that this was high-quality growth and it was sustained quarter after quarter. That kind of consistency is exactly what long-term investors love to see. Okay, so the company is claiming double-digit growth, and that's a pretty bold statement. So now let's get into the nitty-gritty and see exactly which numbers are backing that claim up. First up, this key number, a 12% jump in new business profit. You can think of this as the lifeblood for an insurance company. It's the profit they expect to make from all the new policies they sold this year. A 12% increase means they're not just selling more, they're selling more profitable stuff, which is a fantastic sign for future health. And of course, that profitability flows straight down to the bottom line. Their earnings per share, or EPS, also shot up by 12%. All this means is that for every single share you own, the company is making more profit. It's a super direct measure of the value they're creating for shareholders. And for all you income investors out there, this is the big one, a 15% hike in the dividend. Now, this is more than just getting some extra cash. It's a huge signal of confidence from the leadership. A company just doesn't commit to a dividend increase this big unless they are seriously confident they can keep the cash flowing for years to come. Okay, this table really tells the full story. You can see that 12% new business profit we just talked about. But now look at that massive 69% jump in IFRS profit. IFRS is the official accounting profit, and honestly, it can be pretty volatile for insurers because it includes all the short-term swings in their investments. That's why a lot of investors focus more on the adjusted operating profit, which went up by 5%. This number smooths out all that market noise and shows you the real underlying profitability. The key thing is they're both pointing up, and that's what you want. So numbers like these don't just happen by magic, right? How did Prudential actually pull this off? To get that, we need to pop the hood and look inside the engine room at their strategies for tech and distribution. All right, so how are they getting their products into customers' hands? This slide breaks down their two main channels. On the left, you've got the traditional agents. They're the bedrock of the business, and they grew a very respectable 3%. But then look to the right at bank assurance. That's where they team up with banks to sell insurance. And that channel is just exploding, with new business profit up an incredible 27%. This two-pronged attack is clearly working wonders. Growth isn't just about making new sales. It's about keeping the customers you already have. They're aiming for top-tier Net Promoter Scores, which is just a fancy way of measuring customer loyalty, and they want to keep over 90% of their customers. Tech is a huge part of this. For instance, 70% of new business now goes through auto underwriting, which uses AI to approve policies in minutes, not days. That makes customers way happier and the business way more efficient. Okay, we've seen the strong performance, and we've looked at the strategy behind it. So let's get to the bottom line. What does all this mean for the people who actually own the stock? So let's ask that question directly. With all of this success, what's actually in it for the people who own a piece of the company? The answer is a very, very big number. Prudential is expecting to return over $7 billion to its shareholders in the 4 years leading up to 2027. And this isn't just some vague promise. It's a core part of their whole financial plan. And they've laid out a crystal clear roadmap. They already finished a $2 billion share buyback. That's when the company uses its own cash to buy its stock, which makes every single remaining share a little bit more valuable. And looking ahead, they're planning even more buybacks and are guiding for dividend growth of over 10% for the next 2 years. It's a really clear, sustained plan for giving cash back to shareholders. Okay, so the performance has been strong. The shareholder rewards are clear, but what about the future?
Let's take a balanced look at what's on the horizon, the opportunities in their key markets, and, of course, the risks they're facing.
Well, the view from the top is definitely one of confidence. The CEO, Anil Wadhwani, says it plainly. They expect this momentum to continue, and he's reaffirming their commitment to those really ambitious 2027 financial targets we saw earlier.
So when you boil it all down, this is the core investment case for Prudential. The opportunity is massive. They're set up in some of the world's fastest growing markets, where a rising middle class is crying out for more financial protection. The challenge, then, is navigating the risks that come with being a global player, things like economic uncertainty, market volatility, and changing regulations. For any investor, the big question is whether that huge potential in these growth markets outweighs the risks that come along with them. This content is intended to serve strictly and only as an informational, independent, objective summary of recent events, and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.